Retainage sucks, said all subcontractors or other contractors that have to live with that pain. Although it's been around a long time, it's a tool that's been used by banks and developers for a long time to help get their financing and get projects off the ground, and yet we're going to have to live with it. My name's Scott Pieper. I'm the CEO and co-founder of Mobilization Funding, and today I want to talk to you about how we've seen our contractors, our clients over the last 11 years and people in our network navigate around the constraints of retainage, how they manage through it, and what practices you can put in place to help you do your best in that environment. If you've been living under a rock for the last 40 years in construction, I'm going to explain for a second what retainage is. Retainage is the process of holding back some percentage of the actual contract amount as you invoice it so that you are only paid a certain percentage even though you've completed a certain amount of work. So for example, if you've invoiced $100,000 on a job and there's 10% retainage and you're only paid 90 grand, the retainage is 10% or 10,000. It's basically held back. And it's not necessarily held back by your contractor, so to speak, but it's typically held back by the bank, whoever is financing the overall project, or it might be held back by the government or the municipality or the city. The original intent of retainage was there to help keep people on the job, finishing the job, and making sure that when little things came up after you were on and off the job or jobs were complete, that you were enticed or had incentive to come back and help them finish it, whether it was touch up, punch out, whatever it might be that you needed to do. That was the original intent. I think the intent of it was good, but when you look at commercial construction and the length of the projects and the duration of the projects, really retainage, as well as the percent retainage that's held back, even if it's 5% or 10%, it has a tremendously negative impact for the commercial subcontractor trying to execute the work. Reason being is, if you need profit to help run your business, it's very difficult to have 10% or even 5% retainage held back on your projects because those are directly impacting your profitability and your free cash flow. For example, 5 or 10% doesn't seem like a lot, but if you're running a job at a 20% margin or a 15% margin and you're held 10% retainage, you're getting 50% of your profit held back or more. Any business that has 50% of its profit held back or held at least to a longer duration is running on very, very thin and tight margins. When you combine that with the overall cash flow of construction as it is, it makes it even more and more difficult and adds a lot of pain. We've talked about the retainage. We understand what it is. We understand why it causes problems. And of course, as you're listening to this video, you're like, yeah, no shit. I live with it. But I'm doing this now so I can show you, one, I understand it. Two, I want to walk through now how we can navigate it, how you can make this easier. First and foremost, you have to know what your costs are on your job. Not just your bid and your estimate, but you need to know what the cash flow of the job is going to be. So, in other words, what does that mean? Fancy word, cash flow. Everyone talks about it. And yes, we understand what that is. But what I mean for the project itself is, if you have a certain amount of cost in your bid that you're going to spend, you've obviously marked that up with profit, you've added your overhead, and you've anticipated your way of how you're going to navigate through this project on a certain schedule. But what is key to do is figure out exactly how you're going to spend that cost across that schedule, using your supplier terms, understanding when payments are due, what deposits do you need to make, when is your labor due, when is your subcontract labor due, is there any changes or ebbs and flows in that? Because what is key to understand is what your free cash flow is going to be on that job so you can best navigate and understand exactly what the pain points are going to be in your cash flow cycle. Now, how does retainage impact that? Well, obviously, if you're having money held back on the job, you can't count on a 20% margin in your project if you've built in a 20% margin if they're going to hold 10% back. So you can't, there's an impact. Yes, you may make 20% in that when it's all said and done and they pay you, but you can't count on that extra margin or even that overhead. So if you've built in 10% for overhead, but you're not getting paid that and you're not getting that along the way, your overhead you're incurring along the way. So you're going to have to solve for that cash flow gap because your insurance is due. The trucks, equipment, debt service, other things that are not part of an actual job cost are due. You're going to need cash in your business somewhere to spend that. And if your job that you're working on is not pushing enough free cash flow to you to handle that, you're going to have to figure that out somewhere else. So planning this in advance and understanding exactly how you're going to spend those costs across your schedule is critical for you to figure out, because then you can actually manage to it. It's doing this proactively is the number one best practice for you to be able to handle retainage and the pain points of it. How many times have you been out on that job midway through? If they would just pay me, I'd be okay. If I could just get my retainage, I'd be okay. If you've ever said that to yourself, this is exactly what I'm talking about. This is why it's so critical to do in advance so that you can understand the impacts of retainage. Let me give you some real world scenarios. So we gave you the old, you build 20% margin in, you hold 10% back. What is that going to feel like? How is that going to hurt? Where does it show up? How do I see it? When does the pain come? You know all those little things. That's struggling to figure out how you're going to get your payroll paid this week when you have plenty of accounts receivable. If you're looking at your AR report and you're like, if I could just get paid by my customer, I'd be good. This is what I'm talking about. So what you can do to manage that is, first, you have to understand that cash flow as we talked about. And then you have to be disciplined to make decisions on which jobs you're going to bid. For example, if your company can handle having 10% retainage and 30-day payment terms, then great, no problem. But if you're bidding jobs that have 10% retainage but 45-day terms or 60-day terms, that's going to dramatically impact your cash flow. And the retainage impact of that is also going to be critical. So in those particular cases, if you had 60-day terms, you might need to make sure that you only have 5% retainage jobs. If you have 60-day terms and 10% retainage, those jobs are going to need a lot more margin than whatever job or margin you're going to have in a 30-day pay job with the same amount of retainage. Point being is, if it takes longer to get paid, you're going to have more cash go out. If you have more cash held back, you're not going to have as much. You're going to feel those pain points sooner. So those are the jobs you either have to not do, or when you bid those jobs, you have to bid those at a higher margin, at least another 5-10% margin, so you can cover your overhead costs across that extra 30-day span of when you're paid. Now, once you get paid, you're obviously invoicing every 30 days, typically in a normal construction project, so you'll get paid every 30 days. But bridging that gap from 0 to 60 on the first job, or sometimes even longer if your first billing cycle is a short duration, like you started the job mid-month, it's going to act a lot differently. Those are the things you have to consider, and those are the reasons why some jobs are easier to do and some jobs are harder to do. Those are the reasons why you feel it differently in some of those. It's going to be not the same retainage amount, but the longer duration. Maybe you're trying to pay your subcontractors every 2 weeks. So imagine this. Imagine paying your subcontractors every 2 weeks on a 60-day term job with 10% retainage versus paying your subcontractors paid when paid. Everybody understands that. Case in point, you get it. Imagine if you could pay all your labor whenever you're paid. Obviously, that's not the case. So proactively putting this cash flow together so you can make sure you understand exactly what the negative impacts of the cash flow margin are, so that you can bid which jobs correctly. And you just have to be disciplined on which ones you're going to do. And if you're going to take those 60-day paid jobs, for example, you have to build more margin in them. Now, a customer of mine would say to me right away, well, Scott, I might not win those jobs. And I would tell you, you might not, but that's okay, because you're not going to win that job, even if you win that job, if you do it with a negative cash flow cycle and you actually never are able to receive your profits anyway. So those are the things you can think about. The time you invested in bidding that kind of work, you could just bid more work on the 30-day pay jobs or other customers, or you can negotiate different terms. Which brings me to my point number 2. If you're doing those 60-day pay jobs, those are the ones where you're going to have to use suppliers that maybe it costs a little more. Maybe you pay the supplier a little more for the same type of items, but they give you better terms. They'll give you paid when paid in those cases. Again, putting that cash flow together up front will tell you where your pain points are and give you the levers to pull well in advance, so you're not halfway out on the job waiting to see what's going to happen and then trying to solve for those problems. And the third point, when you're working on these jobs, speak directly to your customers. Don't hide it. Just be comfortable with going to your general contractor or the developer or whoever it is you're contracted with and tell them what you need. Tell them what your cash flow is going to look like based on this retainage, based on what you're getting paid, based on the terms. Figure out a solution. Ask them to see what options there are available to you. If you never ask, you will never receive. But if you do ask, there's a good chance you will receive something. You might not get exactly what you're asking for, but you'll get some relief. Everybody is on that job for the performance of it. No one's there to help get you paid faster. No one's there to help make sure you're successful, but they are there to help you. And so if you need help and you can ask for that help and you need something that can help you perform better, you should share that with somebody and help them help you. Following up on the cash flow piece and just suggestions, you want to look out for what your retainage is, understand the same retainage percentage being held on different jobs with different terms is going to feel differently to you from a cash flow perspective. Mapping that out ahead of time is critical. So you can proactively spend the time on the projects that you need to that will work for you. And also identify the projects that won't work for you so that if you do want to work with those customers, you can make some modifications. Maybe you do have to bid them higher. Maybe you can bid them from different suppliers. Maybe those are the ones that you use all your subcontract labor on because you can have a different term with them. You can pay them when paid. Maybe those are the ones you switch over and do direct labor with because you have better control of cost over there. There's a lot of levers that you can pull in your business, and I see that because our customers do it all the time. When we present these cash flows to them and we tell them where the pain points are and what the options are, they always know where to go and they always make it happen. The key thing is when they don't know, so they never have an option until it's too late and you're midway out. So those are the critical pieces that I want to talk about. Now let's transition into the legal aspects or mechanics liens. So we've all been there, right? You get out on a job, it gets cash flow tight, it starts to get painful, and all of a sudden the supplier jumps out and calls the general contractor, or they call the developer, or they send a notice of pre-lien. Or maybe you're working with your supplier because you need to get them paid and you're using them to help you push the GC for payment. Well, the GC probably hasn't been paid yet themselves because typically most environments, if the general contractor's paid, they're turning those payments around right away to you. It might take a week, but they're turning them around. It's typically they haven't been paid yet and you're pushing on them. It's not the general contractor's responsibility unless they agree to it in advance early to pay you before they're paid. And so those are another thing that you have to pay attention to is the legal terms that you've agreed to with your subcontract agreement. General contractors, they're not there to finance the overall job, just like you're not there to finance the overall job. So pushing them for your payment is sometimes tough to do. Even if they wanted to do it, they don't even have the money to do it. They need to get paid too. So being careful of, proactively mapping out your cash flow will help you prevent the pain and the strain that you're putting on you and your customer. The more you hurt your customer relationship, the less likely you are to work with that customer again, whether you want to or not, or they want you to. So this will help. And then the next thing is your supplier relationships getting strained when they're putting pressure on the project because they're nervous they're not getting paid, but yet you could have known that was going to have problems early on. It's much easier to project and speak to those suppliers in advance saying, hey, look, around the 60 to 90 day mark, I'm going to have a couple $100,000 owed to you in this material, but I'm not going to be able to pay it until I receive my other payout. If you tell them that in the beginning, way different story than being 60 days late and not having your payment. You can work with them then. So these are the types of things that proactive cash flow is going to build for you. It's going to help give you those skills and information and empower you to be able to make those decisions. So you don't want to strain your relationship suppliers, customers when you're working hard and trying to make this work when you could easily proactively see these problems in advance by just mapping out the cash flow. The other solutions we've seen is there's some technology solutions. Maybe customers who are using Textura or GC Pay or other softwares, maybe it'll work faster. Maybe you can get paid faster by putting those programs in place. Do some analysis on your end, the jobs that you're submitting AIA documentation to for bidding and invoicing versus jobs you're doing the same thing, but you're doing it through Textura. Are you paid quicker? Are you paid faster? Does it work more efficiently? Does it not? Find those jobs and those customers who are allowing you to be paid quicker and faster. See if there's anything that's slowing you down in your processes and see if there's a way for you to use a piece of technology, a piece of software. Maybe you lean on your professional services like your accounting firm. Have them map out these projects. You could use our cash flow tool that's free on our website. Doesn't matter where you get the information, but use a tool. Start with your professional services, start with some of the free tools, and map them out so you can see where you're at. And then see if there's technology that you can include into your systems to make things more efficiently, helping you bid, helping you estimate, help you build it. Maybe there's a tool out there that can take your estimate and build it out. You can plan your schedule and it'll map out the actual cost structure for you. Find something that will help you in a technological sense that you can add or bolt onto your company to make things more efficient for your employees without having to add extra employees all the time. Those are great uses of technology to help enhance or make your current employees' jobs easier. And then again, analyze if your customers that you're trying to work for have technology in place, and that speeds the process up. Very often, sometimes if they don't have technology or ways that are helping them, the current employees, sometimes at your customers, they're the ones that are just taking too long. Maybe it takes them an extra week or two to process something, but that week or two means all the difference to you in terms of getting paid. Wrapping this up, in conclusion, here's what I want you to focus on. Two main things. One, we understand the pain of retention. We understand that it's out there. There's no reason to complain about it because it's there. Once you sign on a project, if you sign on for it, you can't get paid. You can't get paid your retainage faster. You should make that part of your plan. So the number one thing to do is proactively plan your project cash flow. What that means is take the costs of your job, figure out how you're going to spend them week by week over the course of the schedule you're trying to keep, find out where those cash flow gaps are, make sure that you're going to have some free cash flow in there that you can use in terms of your profit to help pay your overhead expenses. And if not, what are those cash flow gaps? And so solving for those in advance. It'll enhance your supplier relationships, it'll enhance your performance, it'll enhance your customer relationships. Second thing, find pieces of technology or use your professional services, particularly your accounting firm. And if you're not with a construction accounting firm or someone who specializes in construction and has lots of construction clients they can leverage expertise off of, find one of those. I know all of us have a brother, a sister, a relative, or a family member that's an accountant or a CPA, but that does not mean that they're the best for your business. What's best for your business is someone who has great construction experience, knowledge, and expertise that they can leverage against all of their customers to find out what's best and solve that for you. I hope this video helped you all. If you have any questions, please don't hesitate to reach out to us on our website. If you like the video, share it with some friends, comment, subscribe to our YouTube channel. You can also find me on LinkedIn under Scott Pieper at Mobilization Funding. Otherwise, I hope you all have a great day. Enjoy, and God bless you.